What's going on, everyone? I am Charles Moon, the disciple of trend, and this is my podcast, Buy High, Sell Low. Just want to mention that stock and stock options trading does involve a substantial degree of risk and may not be suitable for all investors. Past performance is not necessarily indicative of future results. What's going on, everyone? The disciple of trend is back at it. Podcast number 5, and this one's going to be a little interesting. We're going to talk about technical analysis. We'll talk about a little bit about tools, the purpose, and why I believe that it's important that anybody, investor or trader that has their money out in the markets working right now should know a little something about technical analysis. Now let's get into it, okay? We're looking at a chart. This is the NASDAQ chart, by the way, and this is a daily chart. So I use bars for the longer term. Some people prefer candlesticks. Whatever the course may be, whatever floats your boat, whatever is easiest on your eyes is what you should work with. Trading is difficult enough. Let's not make it more difficult by trying to force us to learn something that we're just not that comfortable with. But in my opinion, if you have an urge to learn, it gets easier the more comfortable you get. The desirability, the want, it tends to allow you to absorb information much easier, much quicker. And really what happens is that if you start believing in it, then we have something called the aha moment, the truth moment. The moment that you fully trust, I guess, is the air so apparent. There's a lot of people out there that know very bare bones basics, or they ask around and they kind of read a little bit thing, a little article here, a little comment here, a blog here, maybe a podcast. There's a lot out there, but then they try to apply it without really knowing how to apply it. And if it doesn't work out, they tend to give up on it very quickly. So I say this to you. It doesn't matter what it is, okay? There are certain technical indicators that I don't believe in. I'm not going to say they're hogwash. I just don't think they're that applicable, okay? The relevancy isn't nearly as grand, in my opinion. But to each his own. Where you find success is what's important. What works for me may not work for you. What works for you may not work for me. Quite honestly, I've really developed a style and a way and approach, and I've had a lot of success with it. So why do I need to change? There's an old saying in the financial world, okay? Traders are creatures of habit, habitual. And that leads me to other points. That's why chart patterns may work out at times, a lot of the times, let's say, right? That's why reference points work out a lot of the times. Reference points meaning maybe old historic highs or lows, 52-week highs or lows, the 50-day moving average, 200-day moving average, which everybody talks about, or the simple moving average. There's relevancy, and I'll explain why. I've explained in other instances as to why certain things may work out more than others. But the truth of the matter is that you have to find this point where you just are going to believe in it. And it's usually that moment where it's proven to you, right? It's proven to you that it works. I'm going to give a few indicators that I use. Okay, whatever you choose to do with it, that's fine. I'm not going to give all of them. I'm going to give some that could be incredible for the investor and the trader. And then I'm going to give things that are specifically for the trader themselves. And I'll be quite honest with you, these are very common. They're found everywhere. Maybe that's why people don't give it enough relevancy, but I'll explain why it's important. All right. Now, as far as chart patterns go, like I don't know, a descending or ascending wedge or a flag formation, and head and shoulders, I don't do that. I understand it. I understand the structural idea of it, but people are too reliant. It could cause you to allocate too much risk, or not enough risk. It could just be too dependent on just the pattern themselves as opposed to the lifeline or the spirit of the stock. Remember, each individual stock, while it trades in the macro market, is basically its own individual lifeline within that market. Because there could be news within that company that could cause the stock price to have a severe fluctuation in a short period of time, whereas the broad macro markets may be doing absolutely nothing. And so you have to be at least attentive to what is happening within the stock that you may decide to put money in. Now, I want you to understand, opinion is not advice, right? People invest for entirely different reasons. Growth potential, right? Strong fundamentals, macroeconomic conditions, simple advice from a family member. Maybe they didn't even know why they invested a stock and an investment advisor, an IA did it for them. It doesn't matter. What matters is that if your money's out in the market, you have to understand what is happening. Okay, you want to be attentive. You want to care. Now, it doesn't mean that you should micromanage it. I only recommend micromanaging when you're in very short-term trades. Short-term, as in like scalp trades, intraday trades only, where you plan on buying an equity and closing it out before the closing bell of that same day, right? Holding it overnight, swing trading. Holding it for a longer period, position trading. Holding it for years on end, it is an investment. The tragic part is when new traders, trade in the markets. They anticipate on getting out of the markets, and their trade turns into an investment. Usually it's not for a positive reason. A lot of the technical analysis helps you not fall into that really ugly cycle that a lot of newbie traders and even veteran traders and investors in the market get into. One of the sayings that I hear all the time that makes me cringe, okay? But remember, I'm not an investor. I'm an actual trader. It's not a loss until you close it. Granted, in a very bullish market, in large cap names that have performed extremely well, the likelihood of that is very true, right? They tend to rebound back even after substantial downturns and get on its merry way. But then there's names, okay, that just never ever recover. I hope you understand, in essence, even if it does recover, what if it took, let's say, 6 months to a year for it just to get back to your price point that you actually decided to leap in? That means you had that capital tied up for that entire period, not working in other opportunities that could have provided you even much greater yield than you would have expected on that initial investment. Markets, it's a funny thing. It doesn't matter how great you are at technical analysis or even just having a feel for the markets themselves. It doesn't matter. Timing is always going to be of the essence. As a trader, there's a bit of a fine line that you play in. As an investor, you just kind of park it and let it work out its best. But there are instances as an investor where you miss out on immense opportunities to capitalize on the moves. And while at the end of the year, you may see an actual return, a yield, right? Let's say your stock performance finished up 8% for the year. Great. 8% gains. Awesome. But within that 12-month period from January to December, what if the stock ended up 48%, dropped 48%, and then rallied up to finish up 8% for the year? Now, I know not everybody can short in the markets, but you certainly could buy options. You certainly could buy puts. You could do it in investment vehicles. You could do it with a cash account. So the reason why I say that is that if we have, and we're going to look at this chart, a move like this, and you had an opportunity to protect a lot of this move, meaning you're able to cash out, you're only sacrificing a small partial portion of your return to not be exposed to this. And then at the end of the year, while you could have had gains up here, you're looking at gains from here. Now, I'm just giving this as an example on a chart. This isn't the primary example that I really will point out. What if that's the instance? Well, that means you left a lot of money on the table, and reflectively, it's very positive, but not as good as it could have been. So I'm not saying that you're going to be able to maximize, right? Buy at the feet, sell at the head. You won't be able to do that. If you do, great. You're killing the game. Most people cannot time it like that. However, there's no reason why you can't get out near the head and buy in near the feet and not allow yourself to be exposed to things like this. Or what's even better is that once you decide to cash out, if you recognize that weakness and have a reason, you might be able to cash in on that pullback. You could always buy it back in. It doesn't matter if it's Apple or Baba or Facebook. It doesn't matter. You could always buy it back in. Yeah, okay. So for the legacy investors, for those that are holding Apple under, let's say, $200 a share from back then. So what was the split? Down to 7, from 7 to 1, like a 7 to 1, 6 to 1? Okay. So that means, let's say it's at a 7 to 1, you're basically priced in somewhere around $31, $32 a share. Yeah, then I would say, do me a favor, hold on to that for a while. I'm not asking that, but there's people that have been newly investing into these products at peak value, and they had that opportunity where it ran up in their favor and then it washed out, and now it's just starting to recover. Why be exposed to all that? Maybe people just don't care, and that's fine. Maybe people are very comfortable at 4%. But if you ask the average investor, trader, just the average person, would you have rather made $500 on your investment annually, or would you rather have made $5,000? Except for the trolls, any person that understood that question would vehemently answer $5,000. Nobody puts their money in the markets willing to lose it, okay? Of course not. So when you're in this position, let's say as an investor, one of the greatest tools that I've used is the ATR trailing stop. Now, I am going to just say this. I only recommend this for the longer term if you want to manage your portfolio. If you have no desire, disregard. If you do give a damn about your portfolio, if your investment advisor or your broker is just not performing to your like, for me, as a trader, as an investor, it doesn't matter where you buy. It matters where you exit. And if you have that opportunity where you were, let's say, strongly profitable, and you basically didn't want to protect that profit, you are going to let's say, a crap stable and just say, here it is, and just piling it on. Now, of course, people's returns just don't melt away unless they're playing in like high momentum names where we could see fluctuations of a stock price up and down 20% in any given week if the week's volatile enough. If we're playing in stocks that are, slow movers, let's say Cisco, for example, where, a 3-point move in a week is considered pretty big, then in that sense, it may not matter as much. You have a lot of time and you don't have to worry about huge downside exposures and swings. But if you play in products that are volatile enough, let's say even Netflix, for example, recently Boeing, for example, people thought Boeing was automatic. What about 3M and how tragic that's been? Then what? You have to look to protect yourself. So in essence, when the ATR trailing stop is below the bars and below the candles, it's telling you that its expected move is to the upside, right? In my program, we use this stop. One of the cardinal rules for any signal that we give out is that if it's a buy, the ATR trailing stop must be below the market price. If it's going to be a short signal, it must be above the market price. It does two things for one. One, it determines the risk factor, right? The risk allocation for any signal. Number two, it's also given us an ideology based on the stock behavior, right? Recent behavior, historical behavior, what the premise and direction this stock is going to go. And as you can see, once these stops flip, what kind of moves come into play. And so, regardless of what product it is, whether it's the equity or the overall markets, guys, it's telling me whether I should be a little bit more bearish or a little bit more bullish based on the price action and the continuous behavior. So, quick reference, if you haven't been paying attention, 2019 so far has been one heck of a year for the bulls. As you can see, this is the NASDAQ, right? I think the opening print for the calendar year, 6506.91. We hit 8176 this year. We're currently at 7967 in the NASDAQ, okay? Okay? Think about that. Pretty strong bullish run. If you notice, leading into the new calendar year, starting from early October, we were in a pretty bearish downtrend. Early on in the year, we had this big flip, and look at the performance since. Look at what the stop has been doing. And if you're wondering what I'm pointing out, it's these teal blue dots and these pink dots. And if you notice, the pink dots are all above these bars that are below it. And then, of course, the blue dots are below these bars on the way up. And if you notice, as these bars are ascending, looking like a very steep stairway up a cliff, these dots are also ascending. So they're moving in accordance to the overall markets. It's in essence tracking the trend of the markets. And when it's sensing that the trend is transitioning or has transitioned or something has caused the volatility to be, to flip the stop in essence, it's saying something different is going on. It is no longer following the norm, and something is happening here that is different than recent trading history. So I'm going to give a prime example of a very beloved stock. Let's look up Amazon here, okay? Sorry, my keyboard's off to the left here. Look at where Amazon had flipped. The all-time high of this stock is 2,050.50. It is also the 52-week high. If you notice here, September 17th of last year, it flipped the stop. Okay, it flipped it. And while it rallied back over the next month and never came back to the all-time high. And as the market started getting weak, it actually crossed over the 50-day. And then from there, we went from trading in the 1900 range down to 1307, the 52-week low. It started in mid-September. It, meaning this algo, this indicator itself, recognized this, okay? And then, waboosh. But then, of course, how did the market start in this year, 2019? And what has the stock performance been? Important, okay? As an investor, how do you register this? Well, you could absolutely sit here and move your stop up, but people that are investors don't know what a stop really is, a stop loss, right? And I wouldn't recommend it as an investor. But this is where if you just spend, let's say, 30 minutes a week looking at a simple little chart, you could take everything else away and just keep this indicator. It'll tell you when things are going off, when things are off its kilter, right? Off the rails, something is not consistent to what was happening before. And you'd be like, okay, well, maybe it's time to cash out. Or you could cash out and they say, well, maybe it's time to play the other side. So imagine if you were able to recognize this, you're able to buy up all the way up into this level. And once it flipped, you could start shorting all the way down to this level. Once it flipped again, you could buy back in. If you decide to buy back in when it flipped, that was, let's say, at 1650. It got up to 1950. Sorry. Would you be disappointed with 300 points return per share? Per share? Now, there's not a lot of people out there that could buy, 100 shares of Amazon, but 10 shares alone would have been worth it, guys. It really would. It didn't happen over a long period, months. Now we're talking as the investor. Okay? Now, for the trader, you could use this however you like. Again, when the stop flips, I look to be more bearish or bullish. It's in accordance to which way it flips. So if it goes from if it goes from below to above, I'm looking to be a buyer, then becoming a seller. Or I'm looking to ditch it. Or I'm not looking to touch it. If you look at these Momo names, guys, Vive is one of them. Look at the performance in Vive going from, $90 basically to $173. I covered this stock under the Momo names. Look at how long this stop has trailed. Since the stop has flipped this year, it has remained below these bars. So do you want to short this? Contrarian traders will try and short this. At times, they'll be able to time it for smaller gains. But the longer-term outlook, the buyers are winning, and they're winning incredibly well. Okay? And this is very important because if you have the ability to play around in these names, regardless if it's equity or options, well, when you get to options, you're accounting for a lot of different things like implied volatility, and then, of course, you got to account for the Greeks, and then timing. Okay. So it's a little bit more complex. I won't delve into it. But let's just say if you're just trying to play directional moves of a specific equity, then traders, one of the things you must know in conjunction with this ATR trailing stop is something called price channels. Now, you may be familiar with them. You may have heard different variations. A great variation, actually the best variation, would be the Donchian channels. So you could look it up on your actual trading platform, price channel or Donchian channels, whichever way you want to play it, right? Whichever way you want to play it. Now, for me, guys and gals, the importance of the price channels tells me several things. One, it tells me where potential resistance and support may be. And two, it tells me the strength in the name to the upside or the downside. Now, in one of my previous podcasts, I gave an example, right, of swimming in the ocean, and your chance of survival is to either swim with the current or against the current. And clearly, right, common sense says you're always going to be better off if you swim with the current. That's the same ideology as trading with the trend versus trading against the trend. Now, ultimately, the price channels is going to adjust in accordance to extremes over a set period of time. On this example, we're doing 20 days, okay? If it's a daily chart, that equates to one trading month. So the extreme highest printed price of that month or that 20-day period, okay, I don't want to say it because everybody assumes the month will start over that 20-day period, and the most extreme low of that 20-day period. Why do you think that's important? think about how this registers. We're talking about the extremes. So when people reference swing high and swing low, they could reference it on any time frame. But we know the major ones are the highest of the highs and the lowest of the lows. Those are the what we call extreme levels. Why are these levels so extreme? It's the same point as to why something like a simple moving average is very powerful. Because these price levels are tracked by big money. Floor traders, institutional traders, fund managers, it doesn't matter. They like reference points. They need a rhyme or a reason at times. Traders, floor traders, the word traders, they're not out there investing. Market makers will create a market if need be, of course. Funds will distribute cash based on their clients' requests. I get that. But traders, important. HFT systems, important. They are the liquidity of the markets. And surprisingly enough, these levels carry a lot of weight. So these extremes are important in the sense that you know what you're dealing with for the swing extreme high and the swing extreme low. Blah. Blah. All right, guys. There's another purpose, okay? As you can see, I have these allocated as two green lines. When I talk about the extremes, this is important because this price channel, the top and the bottom, will adjust in accordance to the extremes. So if we have a stock making a new higher high or the highest extreme, the channel will move in accordance to that price. The top of the channel will track the extreme high. The bottom of the channel will track the extreme low. Now, when both the top and the bottom of the channel are moving up in sympathy, they're married with each other. This may be the aha moment. Maybe someone already screaming the answer. But here it is. It's telling you that the highs are getting higher and the lows are getting higher. If you folks don't know what that means, it's called an uptrend. The trend is your friend, the disciple of trend. Trading with the current or trading against it. Trend equates to demand. Demand continuing at higher price points. If that demand sustains, the price of that equity will continue to climb. So, if we want to buy a product with the ideology of selling it at a higher price, people love to buy and dig in deep on stocks that are down in its tranches, right? As opposed to buying stocks that have continuously moved up. The thought is, it can't go any higher. Yet, as we keep looking at this one particular name, and it doesn't matter what it is, we could say shop, for example. Let me pull that one up. Whoops. Shop can't go any higher, as people were saying once shop was up 200 points for this year. Yes, you heard me right. Pretty much up 200 points this year, guys. From here to here. So it can't go any higher, and yet it continues to climb. And if you noticed, until recently, the stop has not flipped. And if you noticed, the channels have continuously gone up. And in fact, sorry for all the drawing, I do this as my lesson plan for our clients. You could strip everything away and just leave the bars. You could draw it as a line. You could draw it as candlesticks. It doesn't matter, guys. Anybody could tell this stock has been ascending. It was a good buy here, right? What a return. The power of the trend is significant. You may not want to believe in it, but for a trend in a name that trades, in any name that trades 1 million shares a day, equate that to what the equity price is in cash flow every single day. That's a lot of money. Billions, sometimes trillions in certain instances. Maybe not trillions. That's a lot of money. Let's just say billions. I'm getting too excited. Damn delicious cold brew Starbucks. It's important that you recognize this, guys and gals. Trend is your friend. Now, if you want to be contrarian, by all means, nothing wrong with it, okay? But you have to be very aggressive, just like you were aggressive with your entry, aggressive with your management. Because if you tried to fade the wrong stock and you weren't disciplined enough to exit, that's how margin calls happen, guys and gals. All right? Let's not do that. Now, last but not least, the 50-day moving average, which is highlighted by this orange line here. I call it the 50-day. I should say the 50-period simple moving average. That is the 100-period simple moving average. That is the 200-period. Now, I know people use these types of moving averages on other time frames. I use it when I scalp. I use it on totally different frames. I use a 5, 7, a 9, and a 20 for my scalps, but it helps me recognize early trend, early significance, and sustainability. It helps me define my risk for these short-term day trades. And if you could do it okay, I mean, you don't have to play in the markets around all day. 20 minutes, done. Simple as that. But I prefer these moving averages on these time frames on a daily chart and a weekly chart because of the relevancy they have at these particular levels. You could even take a look at a stock like AMD, okay? AMD here, if you notice, has held this 50-day moving average and has deflected off. Now, I will state that you're going to want to see a previous reference to this level, like recent history, the last time it was basically at this level, to see if it's going to have any sort of validity, right? Let's look at TWLO. It traded through this level, but it's referenced it as support. That's where it's hugging right now. We've seen it in Apple. As you can see, it's deflected off that 50-day simple moving average. Okay, let's look at Facebook. Same thing. Found it as resistance, is now holding up and above. I mean, look at the SPY, guys and gals, where support came in. And you'll see these relevancies, right? You'll see the reaction at these levels. Now, let me just say this. When the 50-day moving average is above all moving averages and the stock price is above that 50-day or 50-period simple moving average, it's telling you short-term strength. If it's above the 100 intermediate-term strength, above the 200 longer-term strength. So basically, when the stock or equity is above all three moving averages, the performance is really, really good to the upside. When it's below, it's vice versa. It's considered bearish. Look at what the SPY did once it got below these levels, and we had the death cross happen here. What a sellout. What a washout. What the heck happened? It was a waboosh. And it's the same thing when we have the cross. We had the cross take place over here. Big extension took place in the markets. Now, I don't want to drag this on. Case in point, in terms of fund managers, floor traders, and everybody else, the basic technical analysis that these guys do, okay, and you can believe me or not, that these guys do are reference these moving averages and these old highs. And what you're going to notice is that these old highs play a role later on down the road. And then as we see extension above and a pullback to those levels, they tend to reject if it's bullish or reject if it's bearish, right? It finds a floor or finds a ceiling, right? And in turn, when previous resistance becomes support, that is bullish. When previous support becomes resistance, that is bearish. You should look to be very aggressive as a buyer if a stock is above these three moving averages. Bearish, obviously, if it's below. If it's in between, it tends to become more like a coin flip. Even if the near-term trend is strong, there are a lot of ceilings or hiccups or resistance points that could come into play. If the big money is watching these levels, you have to watch them too. You cannot disregard it, because you may trade right into that level, not know about it, and have it immediately reverse against you. As a trader, there's nothing like buying high and selling low. The point of this podcast has always been and always will be to help people slowly become informed traders. Take this very basic knowledge that is basic to me but may not be basic to everybody else, and become better traders, or do better for yourself, because it legitimately is us versus Wall Street. That's the name of the game, guys and gals. You want to play in a market that's highly advanced from a technical standpoint without having any sort of advancements yourself. Buyer beware. All right? I'm going to do a follow-up podcast soon on technical analysis. I'll do more. This is the very bare bones basics, but I do hope that it helps. If it's a bit confusing, ask me a question. Drop it in the comments below or send it to my email, podcast@prospertrading.com. Guys and gals, if you like this video, like, comment, subscribe, but most importantly, share. Hit me up on Twitter @DiscipleOfTrend. Follow my company's Twitter if you like, @ProsperTrading. And more than anything else, have an incredible trading week. Many profits, everyone. Many profits. Take care, everybody. Don't forget to like, comment, and subscribe. Also follow us on our socials, Facebook, Twitter, and YouTube. If you have any comments or questions, you can email me, podcast@prospertrading.com. Thanks, everyone.